Today, looking back and looking forward. Hello again, it's Martin North from Digital Finance Analytics. Welcome to our latest post covering finance and property news with a distinctively Australian perspective. And a happy new year to all of those watching the channel. Today, I want to look back over last year and also think about what's going to happen in the year ahead. We are, I think, in uncertain times, and a number of leading indicators will tell us what is going to happen over the next few months. But before I do that, let me just remind you that if you would like to support us to enable us to make more content, then please consider joining our Patreon program. Here's a link. Or making a one-off donation via PayPal. And again, here is the link. Your support is absolutely essential to enable us to continue to make great content. So let's look at the closing indices for 2018. So if we look at the local market first, the S&P ASX 100 closed 0.14% down on Monday, and from a one-year change perspective is 5.84% down over the year. And you can see there was a bit of a peak earlier in the year, but the last quarter has been particularly down. So the closing price was 4,661.70. Now, if you look at the ASX Financials Index, which closed up 0.32% on Monday at 5,564. Over the year, it's fallen 14.38%. So it's dropped further than the overall market. And that was created by multiple crosswinds, including the Royal Commission, the Productivity Report, and the broader financial conditions and funding issues around the world. The bank bill swap rates are 32.21 basis points higher for the 3-month compared with February. And that is putting considerable pressure on the local banks' funding. And essentially they're sitting on about 15 basis points of margin compression, which they haven't been able to recover by mortgage interest rate repricing. In fact, what they're doing is taking rates down for a range of deposits. And what that means is that depositors are paying rather than mortgage holders at the moment, but I'm not sure how much longer that can continue. If we then look at the individual banks, there's actually quite a lot of variation across the sector. CBA, for example, closed at 71.91 and is 10.49% down over the year. National Australia Bank, which closed at 23.96, is 18.97% down over the year. ANZ closed at 24.34 and is down 15.31%. And Westpac is down 20.54% to close at 24.91. So all of the major banks have seen significant pressure on their share price. And this is reflecting, of course, the expectation that future earnings will be lower than historically has been the case, not least because now the banks are having to play by the legal book, whereas previously perhaps they steered a bit close to the wind to buttress their profits, as the Royal Commission highlighted. Greed drove a lot of their behaviour. Macquarie Bank, with a large international exposure, ended the year up 8.99% to close at 108.59, but of course has fallen from 125 or thereabouts since October as the international cross currents have intensified. Looking to the regionals, the Bank of Queensland closed at 9.70, down 23.27% over the year. Suncorp closed down 7.5% to end at 12.82. Bendigo and Adelaide Bank closed at 10.79, down 7.28%. And A&P takes the biscuit, down 52.79% to close at 2.45. And of course, they have been hit probably the hardest by the Royal Commission findings and the disclosure of bad corporate practice. And frankly, it's hard to know what the true valuation of A&P currently should be. Mortgage Choice, the mortgage aggregator, closed down 61.96% to end at 99 cents. So in fact, they've fallen even further. And Mortgage Choice is reacting to a whole bunch of questions around the way that they've handled their franchise operators, as well as questions relating to the future of the mortgage broking sector in Australia. It's clear that there will be significant changes coming through as a result of the Royal Commission. It may well be that we will see commissions effectively replaced by some fee-for-service type structures, but we'll see. And to complete the picture, Genworth, the lender's mortgage insurer, closed at 2.19, down 26.67%. So it's been a down year for the financial sector, and frankly, I think we're going to see this continuing into 2019. And just to complete the Australian picture, the Australian US dollar closed at 70.67, which is down 9.66% over the year. And it's my expectation that the Aussie dollar will continue to slide lower. I'm thinking that it could be as low as 60 this time next year, but we'll see. The spot gold Aussie dollar cross ended up at 1,813.50, which is up 8.66%. So in fact, gold has been a relatively good investment relative to the rest of the market. Can't say that for Bitcoin. Bitcoin closed down 67.95% on the Australian dollar cross to end at 5,240.4. And frankly, nobody knows what the true value of Bitcoin should be because there is really nothing much under the waterline. It is, frankly, a speculative investment. I also note that internationally speaking, some of the bigger investment banks who were thinking seriously about Bitcoin have stepped back, thinking that perhaps they will hold off making any further investments until things are clearer. I think that's probably quite sensible. My own view is don't think of Bitcoin as anything other than speculation. And finally, the Australian VIX, or Fear Index, slipped 0.88% on Monday to end at 1792, but is 75.67% higher than a year ago, and we can see quite clearly that the volatility is increasing. And I think we're going to see more uncertainty ahead. There's a reason why it's called the Fear Index. Now let's look at the international markets with a particular focus on the US. The reason I look at the US is because it's such a big market and has a considerable impact on our own market. In fact, you could argue that our own financial system and the US financial system is so tightly coupled that whatever happens over there is going to have an impact over here. So we start the US indices with the Dow Jones that ended at 23,327.46. It was up 1.15% on Monday. And the one-year change is down 6.7%. Now, it's worth saying, of course, that trading has been very light in the last few days, and a lot of that has been computer generated. So essentially, we won't really know the true state of play until the markets get back in anger in the next week or so. However, it is clear to me that the Trump bump, which was created by the tax cuts and other benefits that flowed into the system over the last year or so is now being changed to a Trump slump, as the chickens are coming home to roost, and particularly as the Fed continues to lift interest rates. The Standard & Poor's 100 index was up 0.86% on Monday to end at 1,103.87 and is down 6.66% over the year. And again, a similar trend with a peak in October and now a considerable fall since then. And the S&P 500 rose 0.61% to end at 2,500 and is 7.03% down on the year. And once again, a similar trend, a peak in October and now falling away quite considerably. Now, it's worth looking at the S&P 500 Financials Index, which rose 0.98% on Monday to end at 395. But that index is 15.5% down over the last year. And interestingly, you can see the slide starting since February and running on through the year with a few ups and downs. This is reflecting the fact that the financial sector is now under considerable pressure, and I think that pressure will continue to grow over the next few months, simply because higher interest rates don't necessarily translate into better returns. And just as an illustration of that, we should look at Goldman Sachs, that rose 2.45% to 167.03, but is 36.01% down over the year. And of course, there is the Malaysian case now hanging over the company, as well as potentially a number of other issues. I regard Goldman Sachs as one of the bellwether stocks for the financial sector. Turning to the tech index, the Nasdaq, well, that rose 0.77% on Monday to end at 6,635.28, but is 4.62% down over the year, and significantly it peaked in October and at one stage was 20% down from that peak, which meant that it was technically in a bear market. It's recovered a bit since then, but again, that's on light trading. So we won't really know the read on the tech sector until next year. But it must be said that a lot of the tech stocks are significantly down, and some of those factors include the trade wars, as well as a range of other issues relating to, for example, potential regulation. Now, the overall volatility index for the US, the CBOE volatility index, or the fear index, actually fell 10.30 on Monday to end at 25.42. But it is 156.7% higher compared with the start of the year and is still in risky territory. So I think we conclude that the markets believe that there will be further volatility in the months ahead. And it's the longest period of high volatility that we've seen for many years. Now, the US dollar index, which is against the basket of other currencies, was down 0.29% to 96.12 on Monday and is up 4.59% over the year. But the 10-year US bond was down 1.90% to 2.686 and has dropped considerably from its high of well over 3%. In fact, the one-year change is up still 12.93%. Now, if you compare that with the 3 months US bond, that was down 0.32% to 2.375, and the one-year change there is up 71.53. So we're seeing this rotation of short-term interest rates relative to longer-term interest rates. And of course, that's why there's been a considerable discussion about potential yield curve inversions. In fact, we are very close to seeing such an inversion, and there has traditionally been a link between a yield curve inversion and a potential recession down the track. So that's why people are watching these rates. But the broader point is that these interest rate moves are partly being driven by the Fed, who lifted rates a number of times through the year. And that higher set of interest rates is flowing through to higher corporate debt and higher costs of borrowing. Now, a quick look at the gold. Well, that was up 0.11% on Monday to end at 1,284.40, and in fact has dropped 1.94% across the year. Now, we saw, of course, a dive into low territory in August, since when it has been climbing more strongly, and that is effectively a mirror image of what's happened to the stock markets overall, because the gold sector is still seen as a potential hedge. But as I showed earlier, what's interesting is that if you take the US dollar movement into account, then effectively the Aussie cross to the gold has actually moved up quite significantly. Now, talking of significant movements, the crude oil futures rose 1.43% on Monday to end at 45.98, but is down 24.74% over the year. And this significant movement partly reflects more supply coming from US shale oil sources, and also OPEC's relative inefficiency and inability to control supply from some of its members. But it's also worth saying that at $45 or $46, it's hard to see how some of those US oil producers will be able to make a turn, and so they might start to dial back production later. We'll see. And finally, let's look at the Bitcoin, US dollar. That was down 3.51% on Monday to end at 3,812, or down 68.19% over the last year. Now, Bitcoin, of course, was a highly speculative asset and continues to be so, and there is little to support its current level. It may go up, it may go down, it's hard to know. So I think we can conclude that this last year has been relatively difficult for anybody holding assets in the stock market. Prices are well down. On deposit accounts, because margins have been chewed. Or indeed property prices, because as we've been reporting through the year, property prices have been sliding, particularly in our major centres. So I think most households with assets will be feeling relatively less wealthy compared with a year ago. Now that's going to have an impact, I think, going into 2019. And before we close out 2018, it's worth saying that over this year, DFA grew its subscriber base significantly, up to around 12,500. So thank you all for your support. We managed to introduce you to a number of new contributors, from Edwin Almeida through to Joe Wilkes, Tony Lecretro, Chris Bates, and Steve King, to name just a few. And of course, my collaboration with John Adams got well and truly underway. So thinking about 2019 now, from a market perspective, I expect to see continued volatility. None of the fundamental factors which drove the problems in the markets last year have really changed. We will see more Fed moves probably later in the year. There is some talk about the trade wars between the US and China perhaps moving to a lower level as they begin to navigate towards some sort of solution, but I'm not sure how realistic that is. And of course, the financial sector will remain under pressure. The volatility is being used at the moment by many in that sector to generate trading revenue. But the underlying issues of debt and the sustainability of repayments, particularly from the corporate sector in the US at these higher interest rates, is a big question. Locally, we will see the Royal Commission finally reporting in February. I think that will be a significant event, not least for mortgage brokers, but also for the management and boards of our major financial services companies. They're going to receive a significant wake-up call. And it may well be that, in fact, some banks will need to restructure or indeed even change their leadership teams. In the housing market, my expectation is that prices will continue to slide. There is very little to change that momentum. And I know that interest-only loans are now potentially more available, but given the tighter regulatory standards that are now in place from an underwriting perspective, I don't think that's going to have a major impact. I also think that these home price falls will continue to spread out from Sydney and Melbourne into some of the other markets that have shown more resilience. I just think it's a timing question. Now, with regard to the financial markets in 2019, my own view is that we're likely to see more volatility and more slides as we go into the first third of the year. I do think it is possible that then we will see the markets begin to move in the other direction. They often do that as they move into February and March. But bearing in mind that there are a bunch of international factors, I'm thinking of Brexit, I'm thinking of China and growth there, as well as continued pressure on interest rates in the US. My expectation is that the financial markets will have another difficult year through 2019 and may well end a little lower. And it's also worth saying that home prices are sliding in many countries now. We're seeing some corrections in Europe, we're seeing corrections in Canada and in the US, as well, of course, as in Australia. So I think the likelihood is that many people with houses will see their values slide over the next few months. Of course, in Australia, we have an election looming, probably March or maybe May. And if Labor were to get in, they will probably introduce their negative gearing changes, whilst they're going to grandfather the existing negative gearing arrangements. New gearing for existing properties won't be allowed. So that will change the market somewhat. My own modelling suggests that we'll have a small negative impact on home prices, but frankly, that will be lost in the roundings given the broader falls that we expect to see from other reasons. I don't think that you can claim the negative gearing changes will be the catalyst for massive home price falls. And I don't think that we're necessarily going to see rental streams being lifted because people's ability to pay is more driven by income than by home prices or indeed mortgage interest rates. Now, the final thing to say is that the wealth effect is continuing to unwind. So our surveys show that many households are preparing to hunker down. They will have had a bit of a splurge over Christmas. Credit card debt might rise a little, but 2019 is going to be a year of protect and survive rather than significant strategic investment, I think. As a result of that, my scenarios continue to play out as expected, and I'll update those scenarios in a couple of weeks. Now, with regard to the DFA channel, we are going to make a few changes as we go into 2019. The fundamental reason for the channel, which is to share data and some insights around the data, absolutely remains. And we will continue to make great content. Now, one of the things we want to do, though, is to try and protect the DFA channel and to ensure that the conversations that we have and the ones that perhaps are politically more charged don't jeopardize the rest of the channel. So to do that, the John Adams North conversations will be moved to a different channel. And I'll give you more news about that in the next few days. So John Adams and I will continue to collaborate around the broader political discussion because we think it's important to intersect the economics, the markets, and the politics of what's going on here in Australia. Because after all, politics drives a whole bunch of other behaviours. Meantime, I'll continue to work with Joe and Edwin and some of the other people we have on the channel. And I've got some other guests lined up as well. And I'd be interested in your comments as to what you'd like to see more or less of as we move into 2019. And yes, at the moment, I'm still intending to make daily posts on the channel because it's clear to me that people really look forward to those daily updates. And I've always got plenty to say. And it's also worth saying that if you want to get more information about our research or see more about our opinions, you can always go directly to the Digital Finance Analytics website and the blog we run there. I'll put a link in the comments below. So, to sum all this up, 2019 looks like it's going to be a bumpy ride. Buckle up, be prepared for it. And remember that the level of uncertainty, according to the volatility indices, both here and in the US, are still in very high readings. And as a result of that, you need to be prepared for the unexpected. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you next time.